now become very important because the Fed staff, of course, will be sticking likely with what they've been putting out for the last 12 months, namely that inflation is still a problem. That's the forecast that we saw, of course, in the latest print from the ECB. But the bottom line to your question is, if there is a change in the forecast, it will have to come from the Fed staff and less so from the Fed chairman.
Is this too highbrow today?
No, I think it's fine.
What's
wrong with this? I think it's good.
No, this is basic. This is the problem. There's a lot of people looking at this, and they're talking about their wife, and they're going, I took her to the supermarket. I don't know why, but I had to start it somewhere. Pretend you got no money. Half of America, John, feels like that British song from years ago.
Common People by Powell, and it's a fantastic song, by the way. We're talking about GDP being sky high. Consumer confidence in this country is the worst it's ever been in the last decade. Just think about everything that's happened in the last 10 years. Consumer confidence hasn't been worse, TK. The Conference Board number is absolutely remarkable.
I agree. It's not a snooze fest. Everyone, you have to stay with us today. It's not a snooze fest.
Is that just to keep the audience?
Plus, Clarity's coming by. You know,
true, and Torsten's sticking with us. It's going to be absolutely fantastic. Coming up as well, we'll catch up with Kathy Jones of Charles Schwab, Subhadra Rajappa of SocGen. That Fed decision is about 18 minutes away. Your equity market just pulling back from all-time highs on the S&P 500. In the bond market, yields up by a single basis point. In FX, near to multi-year lows for the US dollar, and gold at all-time highs. More still to come on the markets in just a moment.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
If I'm an American company and I want to invest in Asia, why would I want to invest in India over China?
India has a lot of similarities to the US. It's a democracy, it has rule of law, it's a capitalist society, and that's what a number of companies are seeing.
In case you missed it on Bloomberg Tech Asia.
It's a very
It's not scary. It's very cute.
Robot. I can patrol for 10 to 20 kilometers
This is the one that's in the U.S. market.
Yeah, it's already in U.S. market for half a year. Many U.S. customers use our robots for package delivery, for fast food delivery, for patrol and inspection, and for firefighting.
Don't miss Bloomberg Tech Asia every month.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
The Fed's in no hurry to cut rates.
They're pretty comfortable pausing here. We're likely to see the Fed pause.
The Fed's likely not cutting.
We think they'll hold.
On hold.
Just stay on hold.
They're in a holding pattern.
It's time to take a break. On these rate cuts.
There isn't really a need for immediate movements in interest rates.
I don't think they want to move.
They're probably towards the tail end of this rate cutting cycle.
Hopefully we see a little bit more guidance from the Fed.
It'll be a dovish meeting even though they won't cut.
The Fed's going to remain data dependent.
Powell is going to stick with the hard data.
We have been dancing around these threats to independence.
The Fed is going to be under enormous pressure.
Everybody wants an independent Fed.
Put their head down, do their job. That's the best way that they can demonstrate that independence.
The Fed decision 15 minutes away. The scores into it it look like this afternoon? On the S&P 500, a slight pullback from record highs. We've gone 5 days with no losses on the S&P. Will these losses stick? In the bond market, twos anchored around to where Fed funds is right now. Let's call it 360 on a 2-year. Tens in a range of 410 to 430 for the year so far. 426 at the moment, and up a single basis point. Where the fun and games have been over the last week, the drama, the fireworks, the headlines. In foreign exchange, euro dollar 119.21 for a heartbeat. Euro dollar was north of 120, and what happened? An ECB member, TK, pushed back against where the euro was and talked up the prospect of acting if this move continues.
That's the game theory of this, and you've got a neo-mercantilist president, and I don't think he understands the game theory of how they'll push back. We mentioned Adam Posen earlier. William Klein at Peterson owns the high ground on this. They push back.
What do you make of the Sell America trade? Seen this headline repeatedly: Sell America. People are selling America every time we have a bit of dollar weakness.
You know where I am on this.
Go on, tell me, share it. I've got views too. I got views too. I'm setting myself up.
I was down in Houston with the CFA Institute, and somebody said the same thing as well. I think it's the craziest thing going. We have led on technology. I'm going to get emotional here. I remember the day the 3 astronauts died at Cape Canaveral. I remember it clear as a bell. We had the technology then. It's different now. We're not going, well, excuse me, Mr. Musk, I know you're listening. We're not going to the moon, but we're there with AI and technology. We're leading the way, and everybody else.
I'm pleased we get to talk about this, TK, because some of the price action we have seen is also consistent with the pickup in global risk appetite. If you see the Kospi at record highs and up 20% for the year, the Aussie outperforming in G10, copper at a record as well, small caps domestically outperforming large, doesn't that just speak to a better growth pickup domestically and internationally?
You know, we made a joke about the British song from Pulp here about the groceries. There's a half of America flat on their back looking for 2 or 3 rate cuts now to relieve them. I'm not sure those rate cuts relieve them.
Kathy Jones at Charles Schwab joins us now. We're going to get into this Fed action. That decision is about 13 minutes away. A news conference 30 minutes after that. Kathy, let's get into the decision. Most people assume no change. Any nuance in the statement you'll be looking for?
In the statement, you might see some adjustment to what they said about inflation, maybe that it has, has stabilized, but still elevated, and a slight tweak there to the statement. Don't expect much else because, frankly, there's no logic to making a change at this stage of the game. So I doubt that there will be a big change to the statement.
Kathy, one thing I've watched in the last 72 hours with the dollar dynamics, and as John mentions, commodities, is the real yield, particularly the 10-year real yield, just as a benchmark, has been very quiescent. What does that mean to you that the inflation-adjusted yield has stayed stable in a tight range?
Yeah, I think that there's some influence here of kind of the stability provided by the Fed now, the expectation for steady policy. You do have the $40 billion in a month that they're injecting into the system. I think some of that is also reflective of just uncertainty. We don't have a really clear vision of where we're going from here. I think there's this hope for this productivity surge to continue. There's hope at the same time that we're going to get, a big boost in the economy from fiscal policy, which seems logical, and yet there doesn't seem to be the market pricing in a huge risk of inflation going forward. And so I think the markets are sort of sitting here, the real yield sitting here, and kind of trying to figure out where to go.
Well, and Kathy, given that uncertainty, why do you think the S&P continues to make all-time highs, including today?
Well, the good thing is, Thorsten, I don't do equities, but I will say that the financial conditions are very easy. When you look at where we are in financial conditions, credit spreads are very tight, corporate profits are near record highs, and the Fed's bias, at least from the dot plot, is towards easing, and a softer dollar. I would say that all kind of adds up to a pretty good environment for the stock market.
Yeah, it's important here. Kevin Gordon had the best tweet out at Schwab yesterday. Kathy took the day off, and Kevin Gordon said, you know what? January feels like it's 9 weeks long. That's the wall of worry that makes equities go up. I believe that's what Ms. Saunders would say.
9 weeks is kind. This feels like about a year.
Yeah.
TK at the moment. Kathy, what's remarkable to me so far is just how stable, until very recently range-bound, the 10-year bond yield has been in the face of all the risks, not just domestically, but internationally as well. Torsten's talking up the prospect of strong GDP growth for the year ahead, maybe even inflation closer to 4, never mind 2, and we're trading at 4.25 on 10s. What gives?
Yeah, I think all the, and I agree with you. I think the yield should be moving higher. We have seen a steepening in the yield curve, and that's really kind of our big call for the year, actually since last year, is a steeper yield curve on the assumption that the economy outperforms expectations, inflation doesn't come down as anticipated or not as quickly as anticipated, and that the risk from the Fed is, particularly with the changes taking place, is that it acts on an easing bias rather than holding steady for longer. I think right now the market has steady policy priced in, well into the middle of the year. If you get a new Fed chair coming in or some rotation of the members that's unexpected due to all these lawsuits, you could probably see a push for easier policy sooner rather than later. And that, I think, would start to get yields moving higher at the longer end.
Torsten, that's my headline of the year so far. It's not sell America. It's the fact that people haven't really been selling treasuries in the face of everything we're discussing. Why are treasuries so stable in the face of all the risks that you're thinking about?
Well, because there's worries now. If the Fed is telling me that short-end rates are going down, well, many people are worried about, well, maybe that means that there is a slowdown in growth coming. But if you begin to add up fiscal policy, AI boom, lower dollar, lower oil, then you do come to the conclusion that maybe those trends will be reversing the Fed's view. And that's why the wait-and-see mode that they're in today is very important. And that's why the communication from Powell about monetary policy will be very critical. Will he begin to signal that there is indeed some upside risks, as we're talking about here?
Do you think yields end the year closer to 5 than 4?
So I do think that 10-year rates at the moment are driven by, of course, the fiscal challenges, but it's certainly also driven by Fed expectations. So if Fed expectations are indeed that rates are not going to move much in the front end for the rest of this year, well, then I do think that there is a chance that long-end rates could be higher.
John Deere, good question here, and I'm going to take this from Orzag and Posen. What's the single catalyst that changes this dialogue? And the answer is it's wage dynamics, inflation-adjusted wages and nominal wages. If you get a wage pop, everything changes in this discussion.
I'll tell you one thing, Tom, so far, it's not Tokyo. To have the convulsions we had in JGBs just last week, and for that to only engineer a 6, 7, 8 basis point move at the long end of the US curve, I was surprised by that. If you told me we'd move by 20 to 30 basis points to the long end of the Japanese curve, see yields we've never seen before in Japan, I would have expected a bigger move last week in treasuries than the one we got.
And you did see yesterday at its 40-year auction in JGBs that actually there was very solid demand, telling you that we're getting to the point where investors are interested in the levels of yields that they're
asking for a friend. Did Apollo load the boat?
I don't think he's going to answer that one. Subhadra Rajappa of SocGen Mai. Subhadra, welcome to the program. The stability in bonds so far, what shakes us out of this recent range?
I don't think there's a clear catalyst, to be honest with you. I think that what shook us out last week was, in fact, the sell-off in JGB yields. We did see a pretty dramatic sell-off. Yes, treasuries outperformed JGBs in the sell-off, but for the most part, that was the only catalyst. I mean, there are other dynamics that we're missing in the bigger equation, right? It's the fact that the Fed has been buying a lot of treasury bills. There's been a lot more issuance in the very front end of the yield curve, and then in the long end, coupon issuances are expected to remain stable for the remainder of the year. So you're looking at a very somewhat stable fiscal situation from a coupon issuance perspective, because a lot of the issuance is coming in bills, and that's keeping a lid on term premia in the US, and 10-year yields, as a result of that, I think are somewhat range-bound.
The history, Subhadra, of SocGen is to really have a pulse on what the bet is on global Wall Street. Is there a bet on this meeting right now?
Not really. I think that the expectation is very consensus that the Fed is probably going to keep policy on hold. And if anything, the market seems to be continuing to push back on the timing of the next easing. We almost have no cuts priced in until June of this year. And there's just a lot of uncertainty. And really, in some respects, it feels like the Fed's job is actually quite easy, because you're looking at a pretty strong growth trajectory. We know somewhat where inflation is. The markets are extremely confused in figuring out what the Fed is going to do, as well as navigating a lot of the uncertainty. And it feels, especially that the bond market feels like it's a deer caught in the headlights, if you will, not knowing where to go from here.
Have we priced in a new chairman?
No, because we have no information. I mean, it seems to be a moving target. We've been discussing this for a better part of the last 6 months, and we still don't know who the next Fed chair is going to be. And there's a good chance that we don't get any clarity by the end of the month, which is kind of was my at least deadline for when we would get an announcement. And it looks like it could drag on well into maybe even closer to May when Fed Chair Powell's term ends. So this uncertainty is definitely here to stay.
I think the senator from North Carolina, TK, has given us a decent steer on just how long this will take. He spoke to us in the last week, and he's communicating pretty clearly that it's about the process and not the man for him. It doesn't matter who they nominate. Until we wrap up this mess with the DOJ at the Federal Reserve, he's not going to even entertain confirming whoever they nominate down at the White House.
I'll go with that, and I'll also go with the idea just here, are we going to have a shutdown on Friday? I mean,
let's hope not.
Do you and I have a different script on Monday?
My goodness, let's hope not. Yeah. I don't think any of us want to go through that again. So, Badger, let's talk about the data, the substance, these conversations about all these other things. There's a reason we're not talking about rate cuts today, and one of the reasons is the labour market data of the last month or so, a pickup in payrolls, a decline in unemployment. How much weight would you put on the recent jobs data?
It's a very important indicator. Again, the data has been somewhat muddy, but if you look at the initial jobless claims, coming into the year, we kind of discounted the very, very low claims number, saying that it was seasonal. But beyond the normal seasonality, claims have been very, very low. And you're looking at a job market that's, seems to be somewhat rebounding, if you will. Yes, for the most part, if you look at the unemployment rate, it's been kind of trending lower. The labor market is extraordinarily tight. So to me, it feels like with 3 preemptive rate cuts last year, it feels like the job market has not only stabilized, but it's also showing signs of improvement.
That's an important insight, that there's 3 already done. It's got to be, 12 seconds into the press conference? He points that out.
I think it's probably right at the top, maybe, Tom. Right at the top. Subhadra, thank you. Subhadra Japa alongside Kathy Jones. The decision about 3 minutes away. Torsten, are you confident we've seen the last rate cut from Chairman Powell?
Well, at least at the moment, it's very clear that the data does not justify rate cuts. So from that perspective, they can certainly go out and explain very clearly. We still have inflation that's too high. We have a labor market that's still okay. And let's not forget that average hourly earnings in the latest print actually went up. And we're beginning to see some of the leading indicators from the Fed for wage growth actually beginning to move higher. And if we at the same time restrict immigration as dramatically has been done over the last 12 months, you should not be surprised if wage growth does begin to move a little bit higher over the next several months.
This sounds like an extended pause. So let me ask you this. The next move after that, a cut or a hike?
Well, I do still think that we are at the bottom of the Nike swoosh, and therefore growth getting better becomes a discussion around, well, is growth going to get so good that we will begin to see inflation move higher? At this point, I think that there are just so many headwinds to begin to talk about rate hikes. So they will be very, very hesitant to do that. He will certainly not be entertaining that idea today.
But you think maybe ultimately that move could be a hike?
Well, because the fiscal policy, remember the CBO says that if one big beautiful bill will lift GDP by 0.9%, GDP is normally 2. So that means that roughly half of GDP growth this year is coming from fiscal expansion alone, while we at the same time have the AI and data center boom in the background. There are some very good stories and reasons to believe that we could begin to see growth accelerate as we go through this year, and that could, by the middle of the year, get to a situation where they will have to begin to talk about rate hikes.
Torsten Slot, can you imagine the new Fed chair going onto the committee, nominated by this White House, entertaining a conversation at the end of the year about interest rate hikes?
Well, that's why that is such a difficult thing, because that person has to go in together with the other voting members. There are 12 voting members in total. This is just one vote. And you need to convince the others and the Fed staff of what you think about is the inflation outlook. And therefore, that will be definitely data dependent and data driven. We need to see inflation go up, and then we'll begin to have discussions about temporary, transitory, what is the reason why inflation continues to be so sticky, which is what the consensus continues to expect.
Just imagine the drama down at the nation's capital in Washington, D.C., if any of that materializes. Torsten Slot of Apollo is going to stick with us. The decision is about 45 seconds away. The equity market is just off all-time highs on the S&P 500. So far this year, we have had tremendous outperformance on the Russell. Small caps underperforming this afternoon. The outperformance from big tech, the Nasdaq up by 0.4%. The attention turns to the Nasdaq a little bit later on this afternoon when we get earnings from Microsoft and earnings from Meta. The attention at the moment very much on the Federal Reserve. In the bond market, 2-year bond yields anchored around 350 to 360, 358. Yields up by not even a basis point on 10s at 425.32, up a single basis point. As we kept saying, the drama, the fireworks and headlines have been in the FX market, with the dollar trading very close to multi-year lows. The Fed decision seconds away, unchanged as the expectation. With the call is Mike McKee.
Well, pretty much as expected, John. No change in rates, and the Fed leaves open the option of cutting rates in the future. Stephen Myron and Chris Waller dissent in favor of a rate cut. Michelle Bowman does not. Waller's dissent, of course, could be read as an effort to retain his place as a finalist to replace Jay Powell later this year. The statement keeps the line about considering the extent and timing of additional adjustments to the target range, suggesting more rate cuts are possible. There's no hint, however, of what that would lead them to do that or when. The economic assessment is very short and relative to recent stations, slightly positive. Available indicators suggest that economic activity has been expanding at a solid pace, it says. Job gains have remained low, and the unemployment rate has shown some signs of stabilization. Inflation remains somewhat elevated. The officials say uncertainty about the economic outlook remains elevated, but they don't emphasize jobs, as they have the last three statements, or inflation as the major concern. The committee is attentive to the risks to both sides of its dual mandate, the statement says. The open market desk at the New York Fed is again told to maintain an ample level of reserves by buying Treasury bills or, if necessary, maturities of up to 3 years or less. It's all about as plain vanilla as you can get, which shifts the focus, of course, to Chairman Powell's news conference at the bottom of the hour. What does he say about the future of interest rates, and what does he say about his future as a member of the Fed? Stay tuned.
Mike McKee, we will stay tuned. The news conference about 28 minutes away. You run into that. Mike McKee there, world class as always. A Fed decision, unchanged. The vote, interesting, 10-2 to hold rates steady. The two, Governor Myron and Governor Waller. TK, is it unfair to describe the Governor Waller dissent as an audition to take the top job at the Federal Reserve?
1991 is classic paper on game theory. I just think we saw a little Waller game theory going on, to say the least. I don't have a strong opinion on it, but definitely that's a setup for the president to make a Waller decision.
This has been an individual, Torsten, who has provided thought leadership on this committee, effective thought leadership now for a number of years. That dissent will be described by many in this market as an audition for the top job at the Federal Reserve. Is that unfair?
I think it is a bit unfair. I mean, Chris is very, very steady and stable and has had his whole career as a PhD economist doing research, going after the data, being data dependent. So I do view this mainly as a sign that he actually is worried. And his speeches have also given very clear indication of this. He is actually truly worried about that the labor market might be signaling that things are about to get worse. So I think it's a little bit unfair to put him into that category, because I do think that it's very important that he is telling us that he does believe that rates should have been cut today.
Is that worry about the jobs market justified by the data you look at?
Well, that's the discussion. I happen to have the view that this is all about the labor supply being much lower. Immigration used to be 3 million a year. Now it's about 400,000 from the CBO. So if labor supply is lower, you should also expect job growth to be lower. Other people, including Chris, put more weight on labor demand. So that's the debate at the moment. Yes, there has been very little hiring, very little firing, suggesting that labor demand is indeed also weak. So this is the very important debate. And of course, only the data over the next several months will tell whether this dissent was actually a good idea or not.
John, for the press conference and for Vice Chairman Clarida, Fed omits language on downside risks to employment having risen. Let's have a chat with some Amazon people this morning.
Yeah.
Let's talk to UBS this morning. The mail I get, the mail you get. People think fancy guys like Torsten Slack are nuts when they talk about a fully employed America.
I don't want to overdo the data that comes from the conference board, because consumer confidence all over the place right now is skewed by a whole bunch of things, including politics. But attitudes to the labour market, when people turn around to you, Torsten, they say right now it's getting harder to get a job, jobs are not plentiful, you have to take notice, don't you?
Absolutely. It is absolutely the case that the labor market data has become slower in terms of job growth. But what is really critical here to remember is that if you have much fewer immigrants going from 3 million to 400,000 a year, of course that's also going to create the break-even rate for non-farm payrolls. That's a lot lower. That used to be 200,000 a year. Now the Fed says it's about 30,000. So the closer you get to zero, of course, the more this will also begin to have more worries among people, whether can I find a job, can I not find a job? And those worries, of course, in sentiment are exactly showing up that, in particular, the lower leg of the K continues to be under significant distress.
The Federal Reserve keeping rates unchanged. If you are just tuning in, as expected, equities on the S&P 500 just a little bit lower, just off all-time highs on the S&P 500. Two dissents, looking for a 25 basis point reduction, one from Governor Myron, another from Governor Waller. Joining us now, a man who knows a little something about how this committee makes decisions, the former Fed Vice Chair, Richard Clarida. Rich, welcome to the program, sir. What do you make of this decision, and what are you looking for from the news conference in 25 minutes' time?
You know, it's as expected, pretty minimal changes to the statement. If anything, as you mentioned, though, changing in the wording about the labor market. I thought it was a close call going in whether or not we would see Governor Waller or Vice Chair Bowman dissent, and in the end, we did get the dissent from Chris Waller. I agree with Torsten, who was on earlier. You know, Chris is a good economist. He's been consistent and had a good call on the labor market and inflation, and he's made the case in many speeches that there is a case to get rates down to neutral. So I take him at his word on that.
Maybe I'll agree.
In terms of the press conference, obviously no SEP projections or the like, and I think the reporters will be pressing the chair on what message they should take away from this in terms of the remainder of the year.
When you look at the politics here, I'm hesitant to say Chairman Clarida,